Welcome back. Well, Snap teased up a big debut on the New York Stock Exchange. It's the parent company of Snapchat. It filed for a $3 billion IPO yesterday, setting the stage for what could be the biggest technology IPO in years. Snap disclosing that it has 158 million daily active users. That's up 48% year over year. But the social media company is still losing money with a net loss of nearly $515 million last year. Joining us right now to look at that and all business today, Strategist Research Chief Investment Strategist and Chairman Jason Trennert. Jason, good to see you.
Good to see you.
Characterize what you're seeing right now. I mean, last year was not a good year for IPOs.
Terrible.
Snap is going to come out. Well, does this liven things up, you think?
I think it does. So IPO activity in terms of both deals and in terms of dollars raised on the equity side was down about 40% last year. And I think, you know, part of that is, part of this is kind of somnambulance of 2% real GDP growth for a long period of time. Part of it also is just the political uncertainty in an election year. No one wants to make big capital investment decisions in a year like that. I think there's no question that animal spirits are on the rise. And I think in my opinion, this bodes well for a big return of the IPO market this year.
We were talking about animal spirits a lot, given Trump's policies.
Yeah, right.
I want to get your take on that, because this is our top story today. President Trump is expected to sign another executive order this morning, beginning to undo Dodd-Frank. You've done a lot of work on the impact on money out of these policies. You just acquired David Malpass's firm. Congratulations on the acquisition.
Right.
What does this mean for the markets and for the economy?
Well, I think listen, I run a small business too. We have about 60 people, and it's hard to really, you can't quantify it. It's hard to model, but so many decisions for small business people are made really based on how you're feeling at any particular time. You know, there's an emotional aspect of it, and I think there's no question the Trump administration is very focused on increasing the confidence of small and medium-sized businesses. I think one of the ironies of the Fed policy over the last several years is that it largely benefited the wrong people. It benefited very large banks, believe it or not, because they could deal with the costs associated with Dodd-Frank more than small and medium-sized businesses. It also benefited wealthy people much more than it benefited from just regular average people. So to me, it's a big change. You're going to see getting the velocity of money up is going to be one of the big goals of the Trump administration.
Can they unleash community and small bank lending? I mean, that's one of the big goals they've talked about. Will the reforms do that? Yeah,
I think, you know, one of the key ways you would do that, see, Dodd-Frank is a little bit different than the ACA. ACA was really just along, as you know, partisan lines. Dodd-Frank's a little different because politically there were both Republicans and Democrats that were on board for obvious reasons.
But writing it, and they didn't know what they were doing.
No, of course. And all these things, it only took, you know, 6 years to complete the 500, I think it was 498
They're not
rules.
even finished, are they?
Yeah, so, I mean, so
50% hasn't been written.
So you have to, you know, it's hard to run a bank when you don't know what the rules are, right? So I think, though, that I think they can. I think one of the ways you could do that, for instance, is changing what you would categorize as a significantly important financial institution. And they're talking about raising that from $50 billion to maybe $100 billion or $150 billion in assets. So I think they're going to do that. Rolling back the DOL rules is certainly for smaller and medium-sized investment managers, investment advisors would be a good thing. So there's, you know, I think there's a lot they can do on that side.
What about jobs? We want to get your take. We got the jobs report out. A lot of focus this month on wages. People think wages are going to move. What are your expectations?
No, listen. I think they should move. I mean, you're pretty close to full employment if you're not including if you're not going with U6. You're not looking at the people that aren't in the workforce. I think one of the fears that people have, obviously, is that you're introducing a lot of you're going to try to introduce a lot of fiscal stimulus and regulatory stimulus at a time at which you're at full employment. Having said that, I think there's room. What we found is that stocks generally don't get themselves into trouble until average hourly earnings are about 4%. Right now you're at about, I think, 2.6 or 2.7, something like that. So you have room, and I think Janet Yellen is comfortable with that. I think her view is that this is the time for labor to actually get some of the spoils from the recovery that we started 7 or 8 years ago. So I think the good news, I think it's okay that wages are going up. I think it's at a certain point it's too much of a good thing, but we're a little ways away from that right now.
You want to comment on earnings? The earnings period seems better than expected. Amazon had a blowout number last night again, another beat.
Yeah, well, this is, I think, one of the unsung heroes in the rally. I mean, you know, the bull market started. People are still calling it a rally. The bull market started on March 9th, 2009, right? So it's not really a rally, or it's a bull market. But this latest part of the bull market, I think, was largely attributed to Trump's presidency, Trump's victory. I think that's very fair. I think one of the unsung heroes in that, though, is that earnings have turned. The first derivative of earnings has turned, which is to say you had a 5-quarter decline, recession in earnings, and that started to turn at the end of last year. So energy is no longer a headwind. The dollar is no longer as big of a headwind. So we're expecting good things from earnings over the next several quarters. Well, you know, maybe up 6%, nothing, you know, kind of outlandishly good. The big increase in earnings, the second derivative, you know, the change on the change, will probably happen in 2018. And that's when you get the kick in from stronger real GDP growth.
Sounds like you're bullish.
I'm bullish. I'm very bullish because the other thing I would say is retail investors have not been invested in this rally yet, and when that happens, I'll start to get more concerned. But still, people have not been playing.
Jason, great to see you.
Great to see you.
Thanks so much for joining us.
Thank
Jason
you.
Trennert.